So there's a lot of optimism that, hey, demand feels really good. There's tenants in the market. It's broadening out. And, for the first time from a financial perspective, you're in a position where 26 going into 27, you're going to be able to post some sort of financial and earnings growth to the market that people want to see.
Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. My guest today is Ron Kamdem, Head of US REITs and Commercial Real Estate Research at Morgan Stanley. Ron has been a long-time expert voice for NAREIT on many REIT sectors, and today he's focusing on the office sector. Ron, it's great to see you face-to-face here at REIT World.
Excellent. Great to be here.
So Ron, several office REITs posted their highest leasing volumes since 2019 in the third quarter of 2025. To what extent would you say the sector has possibly turned the corner on the pandemic challenges at this time?
Really great question. When you think about the office market, I think there are different trends happening depending on where you are in the country. I think Manhattan is far and away the best office market. And that's just not my opinion. You could sort of see some of the leasing stats and the vacancy stats actually that we're watching. But what's interesting is that if you double click Manhattan, even that you have to be a little bit nuanced, right? Because it's Park Avenue, it's Midtown, it's Grand Central, it's Avenue of the Americas. Those are areas that are seeing really good demand. Those are areas that have seen vacancies fall consistently for the post-pandemic. And those are the areas where the tenants want to be. But it's a completely different story if you happen to go to downtown on the Wall Street area or even on the Far East Side. So I would say, again, Manhattan's the best office market by far, but there's even some nuance there by submarket. As you move across over to the West Coast, we've seen some very encouraging signs in San Francisco. For the first time, we've seen positive net absorption, meaning net space demand. We've definitely heard there's a lot more AI-driven tenants in the market. There's a lot of large sort of tech employers that have called their people back to the office. All of those are sort of constructive for that market. So that's one where we are feeling like it's on an inflection point. So said another way, if you think about post-pandemic, this market where vacancy rates are peaking at 30+%, which is, by the way, higher than even the tech bubble, you are seeing enough signs to suggest that that could start to come down. Sublease availability is coming down, which is usually a good sign. As you get to Seattle or LA, which are admittedly can be smaller markets, can be a little bit more concentrated, you have not seen sort of those positive indicators, meaning vacancies are still moving in the wrong direction, activity is still pretty slow. So those are a little bit more cautious stance and so forth. The last thing I will say is just the last piece of the office market that a lot of the REITs care about is the Sun Belt. And the Sun Belt has always been very promising in terms of the amount of in-migration, the amount of job growth, which should be sort of driving demand. And similarly to what I said about San Francisco, when you do look at some of those core markets, there is signs that, net absorption is starting to inflect positively. And to your question earlier, that people are starting to return to the office, activity is starting to pick up and so forth. So that's one to watch as well.
Great. Drilling down a bit more on the return to office, we've heard a lot about those mandates over the last few years. Do you think they've run their course at this point? How effective would you say they've been?
Yeah, I think you've had the big step change behind you. Because if you think about physical office utilization, it was running at about 80% before the pandemic. And then, obviously the pandemic hits and that number drops, depending on where you are, to as low as 20 to 25 to as high as 40%. I think you've seen the big wave, going from 25 to 40 to 60. Some markets are pushing 70, 75. So I think that big wave is done, right? Could you have a little bit more incremental, gradual? Sure. But I think we probably are pretty close to the steady state. Now, there's something important, though, which is if the utilization vary by the day of the week, and I think Tuesdays, Wednesdays, Thursdays are the most highly utilized days. Mondays is coming back, so Mondays is feeling pretty good. Fridays have not really come back. I think Fridays is still a relatively light day. In terms of the leasing decision, though, that doesn't matter. If you're an employee, you need that space. Even if your employees are coming in 4 days a week, you still have to pay for the whole space. You can't just pay for the days in the week. So I think you've seen some encouraging trends. I think you've seen that you've gotten back to that critical mass of occupancy where if you wake up one day, you know that if you're not in the office, you could be missing out on those interactions that other people aren't. Do you have to get back to the 80 that you were pre-pandemic? I don't think you have to, and you may not get there. But, I think you've gotten far enough based on our expectations.
And can you talk about how various geographic markets compare in terms of leasing volumes and how you see those developing in 26?
Sure. Again, I'll go back to sort of the breakdown that I talked about. So if you think about, Manhattan, we were tracking sort of vacancy rate in the market at sort of a 13 to 14% level is number one. It's a market with close to 450 million square feet. And as I said before, this is a market where vacancy has been coming down. Said another way, net absorption has been positive. Less than a million square feet, maybe a million square feet. I think it's up to 3 to 4 million square feet on a trailing 12-month basis. As we roll into next year, everything we're seeing from the public REITs anyways in terms of their pipeline, their activity, tenants in the market, right, that are shopping for space. Some tech tenants, by the way, but in Manhattan, it's a lot of financial asset management and so forth. There's no reason that the leasing velocity that we saw this year will not continue next year, and maybe be even a little bit better, because as you start to take up space, there's that fear of missing out where tenants are more apt to sort of make a decision. So I think Manhattan, just as good, as not better, as we saw in 2025. As you move to the West Coast, I think that's a market that should be better in 26 versus this year. Again, a lot of the trends that we've talked about in terms of finally seeing, like, some of the things we really care about is like not only tenants in the market, but finally seeing that sublease availability start to come down, start to tick down, I think is a really good indicator about tenants' willingness to take on sort of direct space and so forth. So everything from return to office, everything from the trends that we talked about suggests that you're building momentum, and you should see that continue, barring anything else. Similar comments on the Sun Belt. I think of that, and Sun Belt from Atlanta to the Carolinas to Dallas to Houston and all those markets and so forth. Again, the general sentiment would be that you should see leasing velocity improving next year.
And you touched on San Francisco and AI. Do you see tech tenants having an impact in other cities as well?
Certainly in other submarkets, for sure. San Francisco is the heart of it, because that's where a lot of the disproportionate amount of the venture capital fundraising is happening. But I think in like Midtown South is an example of a submarket in New York, for example, that's getting a lot of good traction, getting a lot of attention from tech tenants. There were some talks of tech tenants looking in places like from Nashville, maybe even Charlotte to some extent. So I think you see pockets of it in other markets, and that's all sort of a positive story. But I think the biggest concentration is going to be on the West Coast for now, and maybe a little spillover in some of these other submarkets.
So let's talk a little bit about supply. We've
Sure.
heard about several high-profile office construction projects. Would you say that these are outliers, or do you see potential for additional development going forward?
A couple thoughts. So on the one hand, the new product has leased quite well. It turns out if you have a very nice product, very well amenitized, very well located, there's been a tremendous amount of demand for that. I mean, starting from sort of the One Vanderbilt project that happened in New York, and as you sort of mentioned, I think BXP just kicked off their sort of 363 Madison and so forth. So we're actually pretty constructive on some of the new assets that are coming to market, and think you'll have a lot of good interest, primarily because of the location, which tenants care about, primarily because of the amenities, which sort of tenants care about. But it's also a good opportunity for sort of that flight to quality for people to move into a better quality space. If I take a step back and I think of the aggregate sort of supply deliveries, office is still one of the lowest of all the asset classes. You're talking about 1% or less of the existing stock that's being built. And then you have to think about some of this stock that's actually being taken away from potential office to resi conversion. It's tiny, it's small, it's incremental. It's not 5% of the supply going away, but it could be 50 basis points, could be 100 basis points over time. It's enough to sort of move the needle. So I think overall, I would say you're still in a very low new supply coming into the market and so forth. I think the new product will do relatively well because I think there'll be demand for that.
And there's a lot of focus on the Class A trophy office assets. What about the Class B assets? Is there a role for those going forward?
I think the Class B assets are going to be, they sort of have two challenges to sort of solve to get through. So we know that the product that is leasing, what tenants are saying, what they want, they want the right location, they want the right amenities for sure, to get sort of everybody there. And typically if you're Class B, it's like for one reason or another, you either don't have number one or don't have number two. So what does that mean if you have a Class B product? You got to put capital back in. You got to go on a redevelopment plan. You got to go on a redevelopment project if you wanted to get it back competitive, back to the market to sort of attract new tenants. And I think those holders of those assets have to make a tough decision, right? Because every asset is different, right? Depending on the location, the floor plates, the elevator setup, and so on and so forth, that may not be a good return of capital, right? That asset, the location just may be relatively obsolete, and it doesn't matter how well you renovate it, you're never going to attract a lot of tenants. I think on the one hand, there's a piece of that market that's going to be able to put capital back in, make it competitive, get a lease, and protect the value. I think on the other hand, there's a lot of those assets that the value needs to sort of continue to bleed lower, and then ultimately it's got to be repurposed, rethought, either a bigger redevelopment project into something else and something different.
And something that's really top of mind here at REIT World and elsewhere is valuations in the REIT space. To what extent are valuations impacting office REIT strategy going forward?
There's a couple different ways as a REIT to think about sort of valuation and the impact on the strategy, right? So on the one hand, your valuation is it's the inverse of essentially your cost of capital, right? It sort of impacts your ability to capitalize new deals, do new projects, and so on and so forth. I think the REITs have figured out different ways to capitalize new projects, whether it's joint venture partnerships, selling off pieces of it, rather than doing it all in balance sheet like you would have historically. So they have not necessarily needed to tap the equity markets, for example, to launch bigger projects, to launch bigger redevelopment projects that are capital intensive up front. A lot of the REITs have also had adjustments on their dividends to help sort of retain some of that cash flow to help offset sort of the rise in debt costs that you're doing and so forth. So I would say it's a nice to have, meaning that I think a lot of these projects, capital plans will still move forward at these valuation levels, even if the REITs feel like they don't have access to the equity markets, because ultimately there is JV capital, there's disposition capital, right? You could try to sell assets to fund it. There's enough other capital pools that they can use to try to fund that asset. With that said, valuation would be helpful to the extent that they saw better sort of equity prices or prices started trading above NAV where they felt like issuing could be accretive. That could unlock, some projects and potentials that maybe they chose to sort of forego. But I think it's probably a nice to have, but I think most of the capital plans will proceed regardless of sort of the equity at this juncture.
And we're here at REIT World, but can you say what the atmosphere is amongst the office REITs that you speak to?
Yeah, I think there's a lot of excitement in the office market right now because there's certainly been a lot of leasing that's been done in 2025. And the way the office works is that a lot of times those leases you're signing in 2025, that tenant is not taking occupancy until end of 26 or even 2027. So you've had a lot of leasing through, which is great, but it hasn't really flowed through the financials, the GAAP earnings of the companies yet. And you're not really going to get that full benefit maybe until 2027, again, back end of 26, 2027. So there's a lot of optimism that, hey, demand feels really good. There's tenants in the market. It's broadening out. And, for the first time from a financial perspective, you're in a position where 26 going into 27, you're going to be able to post some sort of financial and earnings growth to the market that people want to see. So this is probably the most constructive and optimistic I've heard the companies sound on their businesses and so forth. We haven't even talked about interest rates, right? Given that this is a sector that has some of the highest sort of debt and leverage levels, to the extent that interest rates continue to come down, which is at least what the forward curve predicts and so forth, that's an additional sort of earnings growth tailwind. Again, that's interest rates is, not part of the stuff that they can control, but I certainly think that this is the most constructive I've heard them in a while.
Great. Ron, we've covered lots of ground, but anything else that you think is important to point out about office REITs?
I think the most misunderstood, interesting part about the office market is it can be both true that certain submarkets are seeing pricing power. Certain submarkets are seeing rent growth. I think we've named some of them. We've said Park Avenue, said Midtown South, Manhattan as an example. At the same time that there is this notable amount of obsolete, low lease, Class B, Class C product that's in the market that may not necessarily be competitive with the A product that those top tenants are looking at, that may need some alternative use solution, that may need capital. I think both can be true. And the key is just finding sort of the right niche and the right exposure for those companies to benefit.
Excellent. Ron, thanks so much for your time today.
Excellent. Thanks for having me.
And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.